Lloyd's of London is today synonymous with prestige, stability, and a rich legacy of nearly 500 years in insurance. However, this institution hasn't always had a stellar reputation. From the early 1960s to the late 1990s, Lloyd's was at the center of one of the largest insurance scandals in history, marked by staggering losses, agent malpractice, and fraud. Fortunes were lost, lives were disrupted, and the debt void was so large it still lingers today. Lloyd's story begins in a modest coffeehouse on Tower Street mentioned in the London Gazette in 1688. Ship owners, sea captains and merchants gathered here to share the risk of lost ship and cargo by distributing it among investors for a fee. Insurance underwriters profited by collecting premiums that exceeded the claims. But typical insurance companies had limited liability, meaning they were only at risk for their investment. If a claim exceeded their investment, the insurance seeker would not be fully compensated. Lloyd's solved this problem by assigning a limited liability to wealthy private investor called names. If names failed to pay, English law guaranteed imprisonment, making it a very safe bet for policyholders. Names benefited too, as pledged assets remained theirs and continued generating income. Lloyd's was recognized as a market maker under UK law, acting as an intermediary between insurance seekers and providers. Brokers joked that if you couldn't secure an underwriter initially, a few drinks would loosen up the next one to sign a policy. Lloyd's was renowned for accepting nearly any policy imaginable. In 2009, Costa Coffee insured its chief coffee taster, Gennaro Pelliccia, against losing his sense of taste for £10 million. Another peculiar case is Australian cricketer Merv Hughes, who insured his moustache for $370,000. High-stakes gamblers at Lloyd's frequently found themselves embroiled in controversies, making headlines with bets on jury verdicts, war outcomes, and even monarchs' lives and deaths. Policies also gained notoriety for always being paid on time, mainly because Lloyd's employed an advisory department to prevent and discourage names from contesting claims. Competitors, on the other hand, disputed every claims and delayed payments as long as possible, like they do today. It's clear now why Lloyd's became so popular. Nevertheless, Lloyd's was losing market share because a single name lacked enough collateral to insure ship owners with multiple ships and large companies. So after months of deliberation, Lloyd's formed its first syndicate, a collection of names lasting 1 year, spreading money and risk among multiple investors to accommodate large clients. As a result, the institution quickly grew to become one of the largest insurance providers in Britain by 1950. It wasn't long before the most popular syndicates had decades-long waiting lists for names wishing to invest. Being a name was a privilege for a selected few. You had to be invited and then elected. By 1958, only 4,000 names existed, all of them British. New names were accepted so slowly that by 1969, when the first American was elected, there were fewer than 7,000 names. Lloyd struggled to accommodate more names because insurance to write was insufficient, and because any outside policy incurred a 20% surcharge as per Lloyd's policy. So, brokers began reinsuring their own excess of loss policies, leading to a frenzy of selling insurance and buying it back from one another. Although technically covered for losses, claims returned liability to the original syndicate, offering virtually no protection. It was at this point that Lloyd's governing body caught on, but instead of punishing the misconduct, it chose to cover it up. Negligence worsened the situation. Agents accepted policy based on rule of thumb, approving any reinsurance policy if it had no claims in the past 5 years. When in 1968 members of the Lloyd's Committee began investigating the asbestosis situation, they quickly came to the realization that 6,000 wealthy British names out of 7,000 were potentially facing financial ruin. The Cromwell Commission investigation report, however, remained hidden for another 12 years. At this point, Lloyd sought to reduce the liability of established British names by aggressively recruiting new names with more assets to pledge. This strategy concealed the true extent of impending losses and resembled a full-out Ponzi scheme, especially since agents earned commissions for each new member they brought in. In 1972, Lloyd's opened the gates to American investors, increasing memberships to 11,000 by 1977 and 24,000 by 1984. Between 1984 and 1985 alone, syndicates grew by more than 30%. A few years before then, in February 1982, auditors warned Lloyd's of the impossibility of closing the 1979 year of account due to unquantifiable losses. If losses emerged, existing names would face financial ruin, making it impossible to recruit new names. Additionally, agents would lose their 20% commission on profits. To address this, Lloyd's tweaked the numbers. deferring all liabilities to next year and forcing names to contribute to reserves intended for losses. Between 1983 and 1990, whilst British names averaged a profit of £150,000 for every £600,000 of premium accepted, American names lost an average of £55,000. In November 1982, the British Parliament enacted the Lloyd's Act, allowing Lloyd's to self-regulate and granting legal protection to its officers. With around 50 Conservative members of Parliament as names, the Act was clear conflict of interests. It wasn't until 1988 that Lloyd's publicly acknowledged potential issues with asbestos claims. However, the full extent of these losses would surface in 1991, revealing a staggering sum of £500 million. This marked a devastating period for many names. Between 1991 and 1993, 36 took their own lives, while thousands faced dire circumstances. Even death couldn't erase these debts. The estates of deceased names remained tied to their policies, carrying their financial obligations beyond the grave. Meanwhile, directors awarded themselves over $2 million in bonuses and continued their extravagant lifestyles, funded by the company until its liquidation. Bill Brown, the most successful broker for Goodall Walker Syndicate, was listed among Britain's wealthiest in the London Times in 1994, earning $15 million in 1989 alone. In that same year, names backing Brown's policies faced losses exceeding $1.5 billion. In 1991, US names filed racketeering charges against Lloyd's in the Robbie case. This was among several cases dismissed by the court because it mistakenly believed Lloyd's had SEC approval to operate in the United States, which it did not. This occurred despite documentation of fraud was collected by various agencies from the US President's Commission on Foreign Economic Policy. In an attempt to bring in new income, Lloyd's agents began accepting increasingly riskier policies, digging an even deeper grave. Lloyd's would declare over £2 billion in losses for 3 consecutive years, from 1992 to 1994. It was during this massacre that Merritt Steven, head of Syndicate 418, launched a scheme in Bermuda to unload its liabilities by purchasing runoff insurance. Many underwriters, including the deputy chairman Murray Lawrence himself, joined the same scheme to shield themselves at the name's expense. But courts began ruling in favor of names. The model of new names covering the bankruptcies of old ones could no longer sustain the illusion of stability. In 1995, the New York State Insurance Department investigated Lloyd's American Trust Fund and uncovered an $18 billion shortfall. British and American insurance faced the largest collapse in the insurance industry, with taxpayers set to bear the cost. But how did this happen? Some attribute it to miscalculations. Syndicates were distributing all profits during good years instead of building reserves to cover less profitable ones. Others blame recklessness, as Lloyd's was unprepared for the long-tail claim on asbestos, pollution and health hazard policies stretching back to the 1940s. Negligence is a good explanation. No one at Lloyd's seemed to monitor just how much insurance each syndicate was writing, though someone should have enforced limits on stamp capacity. What is clear is that fraud was undeniably a central factor. Funds were commingled, fraudulent policies proliferated, losses were concealed, and lies were rampant, all while key players siphoned money from names into offshore accounts. The case for fraud grew stronger when it was revealed that mafia members could manipulate Lloyd's agents, paying them to insure vacant properties at inflated values and then burning them to collect their claims. But the first major sign of malpractice appeared back in 1979, when a non-commissioned underwriter insured $40 million worth of properties that ended up in flames just days after the policy were signed. The Brazilian government invested in this, and, upon discovering the fraud, refused to pay the claims due to obvious mafia involvement. The remaining 110 names in that syndicate had to cover the amount, but not without resistance. After a name won the first lawsuit, it became clear that Lloyd's could not afford the risk of exposing widespread fraud in public courts and drawing media attention. To conceal all, Lloyd's tweaked the books to show consistent profits, ensuring internal audits revealed nothing amiss. When Lloyd's internal regulatory services sought to investigate, they were denied access to the records. It was only in 1993, after years of legal battles, the House of Lords granted the court access to all the records for the syndicate under investigation for suspected fraud. Strangely enough, just hours after this decision, the warehouse housing these documents was destroyed in a fiery explosion caused by a car bomb parked right outside. Nevertheless, lawsuits against Lloyd's continued to mount, with many coming to trial in 1994. Lloyd's oddly hoped that the names would win. A large loss would trigger an external error and omission policy payout. However, since Lloyd's issued this policy, any payout would only deepen the losses. When names did win, only £1.5 billion was recovered from an astounding sum of £9.3 billion in losses. And unbelievably enough, the awarded funds went to Lloyd's rather than the names. Ironically, the only policies that Lloyd's failed to pay were the stop-loss policies that names wrote to protect themselves. By summer 1994, a US government analysis revealed an earth-shattering discovery. Lloyd's had been taking funds from the trust account of profitable names to pay claims for bankrupt ones, without the profitable name having any liability for those policies. The discovery led to the largest legal action against Lloyd's yet, with plaintiffs arguing that Lloyd's Central Fund was operating fraudulently and thus had no legal grounds to collect from European names to cover losses. Until a ruling was made, likely to take at least 2 years, Lloyd's was prohibited from seizing names' properties. Under mounting financial strain, Lloyd's pressured and threatened agents to collect money anyway. Consequently, over half of Lloyd's name either sued or threatened to do so, bringing the industry to a standstill. In 1995, Lloyd's was forced to restructure, separating ongoing policies from its historic losses. All liabilities from before 1993 were transferred to a newly formed company, Equitas, to absorb the staggering $21 billion in accumulated debt, making it the largest startup in history. Equitas, expected to take decades to resolve these claims, was prohibited from incurring further debt and remains the largest solvent runoff reinsurer to date. Yet, somehow, Lloyd's continued its operations. Many names lost everything. Others were pressured into settlements. And in the end, the government handed Lloyd's a $5 billion write-off to absorb the last of its losses. This money came from the taxpayers.